Nowadays, a lot of investors are exploring mutual fund for investment. Within a span of few years, we have seen thousands of crore being invested in the mutual fund. This is one of the fastest growing investment category. One of the major reasons is that investors are now looking for higher return and willing to take that risk to achieve their financial goals. They also understand that in the long term, it makes sense to invest in the Indian economy. In addition to this, there has been a lot of awareness campaign from the mutual fund companies. So by now, most of the investors understand that when they invest in mutual fund, the fund manager will actively buy and sell the securities for them. For example, if you invest in equity mutual fund, the fund manager will actively buy and sell the stocks to generate the return for you. And the fund house will charge a fee for this, which is also known as expense ratio. But have you ever thought, what if you want to directly invest in Sensex or Nifty? Do you know that there is a category in mutual fund which exactly replicate your Sensex and Nifty? And that too at a very low expense ratio. Hi, my name is Sahil and this is my Personal Finance Academy where I explain money management in layman's language. In this video, I am going to discuss the difference between one of the very controversial topic in the Indian mutual fund industry, which is your active versus passive mutual fund. Here, your passive mutual funds are also known as index funds. Active mutual fund supporter says that active funds are better than passive fund, whereas passive fund supporter says that passive mutual funds are better than active funds. But what is active versus passive mutual fund? Active mutual fund are those which are actively managed by the fund house, where the fund manager actively buy and sell these stocks in order to generate higher return. The ultimate goal of each mutual fund is to beat the benchmark. What is benchmark? It is the criteria to check the performance of the mutual fund. For example, if a mutual fund has given 10% return in a year, then what can you infer out of it? Did it perform well or not? For that, you need to compare it with the benchmark. If the benchmark has given 12% return and the mutual fund has given 10% return, then the mutual fund has not done well. But let's say in a particular year, your mutual fund has given 5% return, but the benchmark has given just 3% return, then your mutual fund has done well, because your mutual fund is able to beat the benchmark. For example, Sensex is a benchmark for those mutual funds which invest in top 30 companies in India. Nifty 50 is a benchmark for those mutual funds which invest in top 50 companies in India. Nifty 100 is a benchmark for those mutual funds which invest in top 100 companies in India. So your Sensex is an index that also acts as a benchmark. Likewise, your Nifty 50 is also an index consisting of top 50 companies, and Nifty 100 is also an index consisting of top 100 companies. Your mutual fund house charges a fee in the range of 0.5% to 1.5%, which is also known as expense ratio, to actively buy and sell these stocks in order to generate the higher return and beat the benchmark. But what if the active mutual fund is not able to beat the benchmark? That's where you have the concept of directly investing in the benchmark or the index. Yes, you can exactly replicate Sensex or Nifty with each stock in the same exact proportion. For example, let's say Reliance has got 12% weightage in Nifty 50, then out of your total money, your 12% would be invested in Reliance. And this style of replicating the index is also known as passive mutual fund, or you also call it index funds. The supporter of passive mutual fund says that in the long term, your active mutual fund can't beat the benchmark by actively buying and selling the stock, and the fund houses are fooling people by charging high expense ratio. Hence, they say that it is better to simply replicate Sensex or Nifty in the long term. On top of this, the passive mutual fund have a very low expense ratio. It is almost in the range of 0.1% to 0.3%. Which means the profits are passed on to the investors by deducting just 0.1% to 0.3%. The reason is that the passive fund manager do not have to apply brain in actively buying and selling the stock. The fund manager has to simply replicate the index, because they believe that when you actively buy and sell the stock, you can't beat the benchmark in the long term. And since the active fund charges a high fee in the range of 0.5% to 1.5%, they deduct this fee from your total return, and hence in the long term they can't beat the benchmark due to their high fee. Whereas the supporter of active mutual fund says that in a developing country like India, where there is lot of inefficiencies, that is, there are a lot of companies that can potentially generate high return, it makes sense to invest in active mutual fund where the fund manager would actively buy and sell the stock to generate the additional return and beat the benchmark. That is, there are a lot of companies that can potentially generate higher returns, and it makes sense to invest in active mutual fund where the fund manager would actively buy and sell the right stocks to generate higher return than the benchmark. Now if you look at the developed countries like US, most of the investors invest via index fund where the active funds are not able to beat the benchmark and the passive funds are available at a very low cost. But in a developing country like India, where there are a lot of inefficiencies, this topic is highly debatable. That is, whether the active fund will be able to beat the benchmark in the future or not, and whether it makes sense to invest in active mutual fund or passive mutual fund. However, if you compare the historical performance of the active funds in the large cap category, you will observe that a lot of funds are not able to beat the benchmark. It means that there are high chances that you might end up investing in the active mutual fund with high expense ratio which is not able to beat the benchmark. Having said this, there are still a lot of active mutual fund which has beaten the benchmark and given higher return than the index funds. But the question is, will they continue to beat the benchmark in the future as well? One advantage with index fund is that it might not be able to give you highest return, but it won't give you the worst return. So it will lie somewhere in the middle. So if you are someone who do not want to take too much risk or do not want to apply lot of brain in picking the active mutual fund, you can consider the passive mutual fund or the index funds. But there is one catch. Most of the index fund in India replicate either the Sensex or Nifty 50. There are a few funds which replicate Nifty Next 50 or Nifty 100, and they are all catering to large cap category. So if you are someone who want to have exposure in the mid cap and small cap segment to generate potentially higher return, then you would need to build a balanced portfolio with exposure in both active as well as passive mutual funds. Because the passive mutual fund or the index fund do not cater to mid cap and small cap segment. For example, your active mutual fund category like multi-cap category caters to large cap, mid cap as well as small cap, where the fund manager actively buy and sell the stock between large, mid and small as per the market condition. So I personally think that categories like multi-cap category has higher potential to beat the index funds because it includes your mid cap as well as small cap segment. In the future, when the Indian market develops, I expect the index fund in the category of mid cap as well as small cap. So in the future, we might have a passive fund or the index fund replicating Nifty 500, which is similar to your S&P 500 of US, where the investment is in the top 500 company instead of just top 100 companies. And that would be a more broader allocation where the investment would be in large, mid as well as small cap segment. But till then, the portfolio should have a right balance between active versus passive mutual fund. So I hope with this video, you got the understanding between active versus passive mutual fund and what are index funds. So what do you think? Which is better, active fund or passive funds? Also let me know which financial topic you want me to cover in the future.